So the key idea, as I say, is that it's all about real assets. You know, that's what creates value. Right. Let's see, does this thing. And if that's true, if what M&M say is true, it allows the separation of investment and financing, and remember that's a good thing. I mean, insofar as you can simplify decisions, you're likely to make better decisions. So that's a kind of a basic rule of anything. Insofar as you can simplify decisions, you're likely to make better decisions. In other words, if you can concentrate on the asset decision and make it, and separately make the financing decision, you're likely to have better results rather than having two balls in the air at the one time. Okay, so that's the basic idea. That's the basic idea there. Now, however, in practice, financing decisions do matter. So we've got to understand why they matter or when they matter. Okay, so that's the thing. Now, to get a picture, so that's the overall kind of big high level. Now, let's drill down into this to make sure we kind of understand it. Okay, so given a firm's assets and investment plan, you know, find the debt proportion that maximizes firm value. You know, okay, because remember, M&M say it doesn't make any difference. There's no such thing as a debt structure, a D over V, or debt equity, whatever way you like to express it. There's no such thing as a debt structure that is better than another. Another way of asking that question, is there a debt structure that maximizes firm value? Okay, so let's look at that then. Given the firm's assets and investment plan, find the proportion that maximizes firm value, which M&M say couldn't be. But anyway, let's look at that. So we've got a balance sheet here. It's a real balance sheet. We've got our assets. We've got our growth opportunities, whatever they are. You know, I suppose you got another word for that would be NPV. We've got our debt and we've got our equity. So our assets, our debt and our equity, well, we're familiar with that concept, and our growth opportunities. That's just another way of expressing net present value. Okay, so we've got a little balance sheet there. So let's play around with this balance sheet to see what we can learn from it. Okay, so out in the market we observe debt is equal to 50. We observe debt is equal to 50. We observe equity is equal to 50 as well. In other words, we look at the bond market and we see debt trading at 50, equity trading at 50. That means the value of those securities is 100. So what's the value of our assets and our growth opportunities? What's the value of the asset side of the balance sheet? Yeah, 100. Gotta be. It gotta be. Okay, so that's 100. Now, so that's just basically setting it all up. So we issue new debt of 100, issue debt, pay a dividend of 10, pay a special dividend of 10. What happens? Well, our debt, our old debt is 50, our old debt is 50, our new debt is 10. Okay. What's the value of the assets going to be?
Plus 10.
What's the value of our this side of the balance sheet here?
No, it will remain 50. Because we paid
Oh, wait.
90.
What was it up here?
Sorry, 100. It will remain 100 because we paid out 10 as a
Yeah.
dividend, and we got 10 from financing.
Yeah.
So it will net off and it will remain 100.
Yeah, exactly. In other words, that's one way of putting it. Another way of putting it is, well, the assets are worth 100. The assets are worth 100. And playing around with this side of the balance sheet is not going to affect the value of the assets. Remember we said the value of your house is independent of who owns it. So this will remain 100. So in fact, in a way, it's the other way around. It's the other way around, really. The assets have a value. Let's go up here. The assets have a value of 100. How do we know that? Well, we know that because we see the debt trading at 50 and we see the equity trading at 50. it's not the other way around. It's not that the debt and the equity are equal to 100, therefore the assets are equal to 100. No, it's the other way around. The assets have a value of 100, and we can see that because we can observe the value of the debt and the value of the equity. You see, that's what markets do. They value things. They don't create value. They value things. They don't create value. They value things. And that's, I suppose, one big job of a market is to value things. The other is to allow assets to be bought and sold. But fundamentally, they value things. So they would value, for instance, Coca-Cola. I mean, Coca-Cola would be a hard firm to value, wouldn't it? Because what's the big asset that Coca-Cola has?
Goodwill.
Well, I mean, that's a fairy tale accounting way of saying, but what's the real proper English?
Brand.
Yeah, it's got a brand value, hasn't it? It's got a brand value. You know, the brand is worth something. In fact, I don't know, but it's probably worth 95%. In fact, Coke could outsource everything. It could have no other assets. You know, it could get somebody to manufacture the Coke and somebody to deliver the Coke and all this. And it could have no hard assets, but it would still be worth whatever it's worth. Of course, it's only a market can value that, isn't it? It's only a market can value that. Okay, so that's fine. So what's the equity then going to be worth down here again?
40 also.
Yeah, okay, so it's fairly simple, fairly simple sort of stuff. Okay, key idea though, the value of the assets has got to remain the same because the assets haven't changed. I mean, 10 went in and 10 went out, which is just pure cash. So that's gone in and out, so it's still the same. Okay, that's just a cunning way of changing the asset side or the liability side of the balance sheet, isn't it? The financing side or the ownership side of the balance sheet without changing the asset side of the balance sheet. Okay, now, remember this is a real balance sheet. Now, let's look at this now. We haven't forgotten that example, but an announcement kind of, a shareholder's gain from a shift in the capital structure if, and it's a big if, and only if, value increases, okay, or some other class of security holder loses. Okay, so let's probe both of these things. Shareholders gain from a shift in the capital structure if value increases. Okay, so let's look and see what happens there. Let's go back to here. Now, let's say we've agreed here that equity was equal to 40. We agreed equity was equal to 40. Now, after this, let's say, just amazingly, but let's say after this little 10 in, 10 out operation, let's say the value of the company, the value of the assets, I should say, let's say the value of the assets was 102. Let's say it went up to 102. Don't ask me how it could happen, but let's say it did happen. Well, what would the debt be worth?
Still remain the same.
Right, it'd be 60, isn't that right?
Yeah.
And so what would the equity be worth?
More.
How much?
The two.
Yeah, it'd be 42, wouldn't it? Okay, so that would be an example now. That would be an example of a shareholders gaining from a shift in the capital structure because value increases. So if the value of the assets increase, the debt holders don't share in that, sure they don't.
No.
The debt because they're entitled to put 100 in, they get 100 back. So that's the deal with debt holders. They don't get back more than they put in. So any extra value goes to the shareholders. Now, of course, but you can see in some sort of theory, you could imagine that if the value went up, the shareholders would gain from this change in the capital structure. But it's impossible to see how that could happen. How by changing the ownership of the company slightly, or even more than slightly, how the value of the assets could increase. So we can forget about that. So in other words, again, it comes back to the point that ownership doesn't affect value. I mean, except in very peculiar situations. I suppose you could say, like, for instance, when the state owns assets, state owns assets, well, probably the value of the assets gets reduced. You can imagine that. Or indeed, cooperatively owned assets. In other words, you can imagine that in assets that are owned by a cooperative society, you can imagine those assets are reduced in value because maybe they're not managed properly. Because, of course, in a cooperative society, nobody really owns the assets. Nobody has a real interest in the assets in a cooperative society. You know what I mean by cooperative society, you know. Nobody really has an interest in them. And in a government-owned assets, nobody really has a huge incentive to make sure you're getting the value out of them. But they're extreme examples. But normally, doesn't make any difference who owns assets, no increase in value. Okay, now, so we can forget about that. We can forget about that, I suppose. So then, shareholders gain from a shift in the capital structure if and only if some other class of security holder loses. Okay, so this is interesting. This is interesting and peculiar. Let's have a look at it. Okay, back to a balance sheet. Observed debt to be 50, equity to be 50, the value of the company, the value of the security is 100, therefore the value of the assets must be 100. In fact, it's the other way around, but the value of the assets are 100. Now, do the same thing again. Issue new debt, pay a special dividend of 10. What happens? Okay, now let's say in this case, let's say in this case, the new debt is secured and the old debt is unsecured. So the new debt is secured and the old debt is unsecured. Okay, if you're an old debt holder, and you see that there's new debt come in and it ranks ahead of you, in other words, you're the old debt holder unsecured, the new debt holder comes in and they're secure. That means they're ahead of you. Are you going to be happy or sad? Sad, isn't that right? Yep. No way around that. There's no way around that. Somebody else is going to get their nose in the trough before you. So you've got to be, you're not going to be happy, you've got to be sad. If you're sad, the value of your debt has got to go down, hasn't it? Isn't that right? In other words, before the debt was worth 50, now it's clearly less valuable, because if it weren't less valuable, you'd be happy. You're sad. We've agreed you're sad, so that means it's less valuable. Isn't that true? So let's say it goes down to 48. So there's new debt come in, it ranks ahead of the old debt. The old debt is now less valuable because it's more risky, I suppose. In a bad scene, the old debt holder will get paid out after the new debt holder. So let's assume the level of the sadness is measured by 2. So the debt now has a value of 48.
Sorry, I don't get that. If it's mezzanine debt, say it's ranks behind.
Well, why don't you keep it simple? You've got unsecured debt and you've got secured debt. Okay, so this is unsecured.
Yeah, but the value of the debt is still recognised on the balance sheet as whatever it's drawn at.
Yeah, that's true. But I mean, have we not described an accounting balance sheet as a fairy tale balance sheet?
It's not fairy tale.
Well, it's got to be if it says it's 50 and the thing is worth 48.
Well, if I'm a banker and I have a utilised facility with my client at 50 million and it's recognised on the balance sheet at 50 million, that's what it is.
No, it's not. Sure, that's what these guys spend their lives working at. They see debt on the balance sheet at 50, on the balance sheet of the bank at 50, and they spend their time worrying, has it got a value of 50? Mm-hmm. Isn't that what you guys do?
Yeah.
Isn't that right? Isn't that what these bank examiners do? I mean, if they were able to take your suggestion that it's on the balance sheet of 50, bank balance sheet 50 as an asset, liability on the borrower balance sheet as a liability of same 50-50. If what you said is true, you wouldn't have to worry. She wouldn't. They wouldn't have to worry. Is it or is it not true?
Well, to an extent, but then
well, hang on.
clients paying interest on that balance, aren't they?
Yeah, they're paying interest, but whether it's worth 48 or 50, they're still paying the same amount of interest. But your point really is that it's not worth 48, it's worth 50. That's what you said. But if what you said was true, these guys are completely wasting their time. Now, which could be true, of course, but is that not the problem in a bank? that the bank has an asset of a loan, 50, the borrower has the equivalent liability, 50. If what you say is true, nobody needs to borrow, it's worth 50 and that's the end of the problem.
No, I'm just recognising that the balance sheet, and what you would normally.
Well, hang on, but you're saying you're recognising, but you're saying that means you're writing it down on the balance sheet as 50. You're sorry, not writing it down, but you're writing down 50.
Yeah.
Okay. Well, writing numbers on a bit of paper, I mean, how does that convey information, or how does it affect a reality?
That's what the bank's lent that.
Yeah, sure, yeah. And is that what it's worth? I mean, if the bank knows it's only going to get back 48, is it still going to be writing down on is it still going to write the number 50 on its balance sheet?
So what you're saying here is that the bank's only going to recognise that they're going to get 48 back.
No, I didn't say that. I didn't use the word bank here. I just said that, in fact, this debt is trading on the market. We said that new debt comes in, 10, secured, old debt, unsecured. And we agreed, now you didn't object, I'm sorry to be arguing vigorously, you didn't object, we agreed the old debt holders are going to be not happy, they're going to be sad, isn't that true? And if they're sad, they're sad for a particular reason. They're sad because their debt is now more risky. Isn't that true?
Yeah.
So if it's more risky, I mean, they're still getting the same amount of interest, remember, but that risk, their risk has gone up.
Yeah.
So the debt is less, it's got to be less valuable, hasn't it?
Okay, I see what you mean. So
You
you're
know.
just calculating the risk associated with what? The original debt?
Yeah, well, it's just, just saying.
Yeah.
Well, I'm not even calculating, I'm just saying, when you observe it on the market, the thing has gone down to 50, 48. Okay.
At that point in time, yeah.
Yeah, okay, yeah.
But in a gone situation, the bank would recognise.
Well, you keep using these words like recognise. They don't help us to understand the thing. I mean, we've got to understand that an accounting balance sheet doesn't represent necessarily real values. And we're interested in real values. And of course, banks would never go bust if bank balance sheets represented real values. Isn't that true? Yeah, so I mean, that's why, as an exaggeration, I describe accounting balance sheets as fairy tale balance sheets, because they don't necessarily, now it is an exaggeration, but they don't necessarily, and they don't claim to represent economic realities. Okay, and that's a very important, the easiest way to make mistakes in finance is to pay too much attention to accounting balance sheets. And real finance people don't, of course. They take, like these guys do, they take a balance sheet and they turn it into a real one. And same way as a lender, when they get a balance sheet from a borrower, they take the borrower's balance sheet and they turn it into a real one. They start to make adjustments. They say, well, these assets are, the inventory is overvalued, we'll knock 20 off that, and the debtors knock maybe 10 off that, and the property is undervalued, we'll add 10 onto that. So they create their own little balance sheet and figure out how to, and then they do work in the cash flows as well, of course. Okay, so we can see, now, of course, you see, partly this has helped, partly this is partly the problem is exacerbated in our heads because we're thinking of borrowing from the bank. Now, remember you said you borrow from the bank, and I said, no, we didn't say that. Now, you can see, of course, if this is traded debt, it just goes down in value because the guys know they've got screwed. Okay, now, but if you've borrowed from a bank, it doesn't happen like that because, bank debt, it doesn't reflect, it doesn't reflect necessarily values. I mean, if you go into your bank, if you did this with your bank, and you go into your bank and said, listen, I'm sorry, bank, but we've gone to another bank and borrowed 10, and this 10 we've borrowed is secured, and you're not secured, that means your debt is now worth less. I figure it's only worth 48. Why don't we shake hands and we'll agree it's worth 48? And of course, we know the bank will tell you to get lost, won't they? Because that's the way it happens. Because, of course, they can't afford the transaction costs of me coming in with this proposal, you coming in with another proposal. They just have a rule which says, look, that's the end of it. It's 50 and 50 and 50. It's what's written down on the bit of paper. That's the way we live, and we'll only adjust it downwards when the liquidator finds out about it or decides. Okay, so in this finance business, particularly with debt, you get better intuitions if you think of traded debt. You get better intuitions if you think of traded debt, and you get bad intuitions if you think bank debt. You get bad intuitions if you think bank debt. Okay, now, of course, the assets are still worth 100, isn't that right? The debt is now trading at 48. This old new debt has a value of 10, it's trading at 10. Well, that means, of course, the equity has got to be worth 42, hasn't it? It was worth 40. Was worth 40, now it's 42. Now it's 42, yeah?
So is it possible that the equity is trading at 42?
Well, it's got to be trading at 42.
Supplemental compensation.
Well, it's got to be trading at 42, doesn't it? Because the assets are worth 100. This debt is going to be trading at 48. This debt is going to be trading at 10. So that one has got to trade at 42, hasn't it? Huh?
I can't imagine the market, I can't imagine the stock market adjusting the value of equity because that same company has, the value of their debt has gone down
What else would happen, though?
in real life.
Yeah, of course, yeah, particularly in real life. What else would happen?
It's like your bank balance, if you got the debt, you're not paying on that debt, then mean your balance has positive cash rather than cash which is going up.
What else would happen? You can't imagine anything else happening. I mean, I know, it's hard to get your head around, no, I accept that. No, it is hard to get your head around. But there's more to come, more to come. So when we said shareholders gain for shifting to cap if some other class of security holder loses. So that's what happened here, hasn't it? The old debt holders have lost, and the shareholders gain. So this is suggesting that M&M could be wrong sometimes, because we can easily envisage a situation where a class of security holder loses. In other words, debt holders get screwed, and the shareholder has to gain because that's the way it got to happen. Now, but you might say to me, well, okay, I can see that, but it's a bit like an accounting thing, isn't it? It doesn't mean anything. You might be saying that. Because you'd also say, well, look, hang on. This debt has a face value of 50. I mean, you owe the bank 50. Sorry, I shouldn't say the bank. You owe 50. You owe the 50. You owe the 50. And if you don't pay it back, you're bust. You go bust. You can't go along to the bondholders, in 3 years' time when the debt is due to be repaid. You can't go along to the bondholders and say, yeah, it's only trading at 48. I'm only going to give you 48. No, you can't say that. They're saying, you owe me 50. I want 50. And once you pay the 50, and you have to pay it, otherwise you're bust. If you don't pay the 50, when you do pay the 50, what happens to your 42? It goes back to 40, doesn't it? Okay. So next question is, how do you lock in your gain? How do you lock in your gain of 2? How do you ensure that the 42 remains 42? How do you capture that? Because as you move towards the repayment debt of the debt, that 42 gradually becomes closer to 40, as the 48 becomes gradually closer to 50. So how do you capture that 42? How do you capture that 42? Lock it in for good. Permanently screw the debt holder. So how do you do it?
You sell the debt?
Sell it? Well, hang on. You can't sell a liability. Sure you can't. Normally you can't anyway. Unless you find a mug. So how do you lock in that 42? What are you saying? You what? I mean, just use words that I understand. Huh? What?
To buy an option or something to take it at that price. So
Yeah, okay, but that's true. But, well, possibly true. But the person that sells the option has got to have a way of not losing, isn't that right?
Yeah.
So, I mean, it doesn't, you're still left with the problem. Somebody has got to have a way of not losing.
It's only the asset side that they have.
Well, hang on, the asset side, you see, will remain 100. Which is why, of course, when the debt is due to be repaid, you pay 50, and you're able to pay 50. But how do you stop yourself getting to the point of paying the 50?
Borrow again.
What?
Borrow again.
Yeah, borrow again. Okay, and do what? What do you do with the money you borrow?
Pay the old debt.
Yeah, okay, you got it. In other words, remember this is traded debt, so you go into the market,
Borrow at a cheaper rate.
you borrow 48, let's say. You borrow 48, you go into the market, buy up the old debt, which is 48, and now that's it, isn't it? You've locked in. So it's perfectly, in a way, perfectly simple. And it's got to happen like that. You know, you borrow, you don't even have to borrow, but yeah, but like you say, if you borrow, it keeps everything as apples and apples, everything is the same as it was. You borrow 48, you buy back the debt in the market, remember, because it's trading at 48. Buy it back. Then you've captured your extra 2 for good. The bondholders, the old bondholders, have been permanently screwed. They're not going to get repaid 50 because they've sold the right to get paid 50 for 48. So now there's okay. So you can see there's got to happen like that. Now you might say, "Oh, I'm not sure. Can people be that stupid? Can people be that stupid?" Well, of course, there's unlimited capacity for people to be stupid. First of all, it's part of the mystery or part of the problem of capital structure. It's part of the problem of capital structure because actually, when you think about it, the more debt you have, the riskier it is, and the greater the more you will be affected by somebody doing something like this. So the size of the debt is important. The size of the debt is important, which is relevant to the whole discussion here. But if we just again step back and say, some other class of security holder loses. And I say down here, the Marriott example. The Marriott example. Okay, so let's look at the Marriott example. Right, oops. Let's look at the Marriott example. Okay, we'll do it over here. Okay, so Marriott. You're all familiar with Marriott. Hotel. Okay. Okay, so the old Marriott. Okay, the old Marriott. So this is the old Marriott, you know. The old Marriott is made up of hotel operations and it's made up of property. You can imagine that's exactly what a traditional hotel would look like. It's made up of, the business of running the hotel, and it's made up of owning a bit of property, owning the property in which the hotels trade. Okay, and you're probably familiar with the fact that most hotels nowadays, the property owner is different to the hotel operation owner, so to speak. Okay, so at some point, Marriott split their operations in two. So in one company, they had hotel operations. In one company, they had hotel operations, and in another company, they had property. Okay, so they split their. Previously they had one company. Afterwards, they had two companies. One of which is the old company. So they create another company, and in the new structure, they had two companies. One of which was the old company, and in one of these companies, they had hotel operations, and in the other company, they had the property. And of course, up here, they had debt as well. Okay. Now, my question is this: in the new structure, where do you think where do you think the debt went? Where do you think the debt ended up? Okay. Oh, property? Why do you say that? Well, they had the property. Now, see, nothing has changed. I mean, they had, in the old corporate structure, in the one company, they had hotel operations, property and debt, and then restructure, and they have two companies, one of which is the old company, but in the two companies, in the new structure, one, they put the hotel operations, the other, they put the property. Where would they put the debt?
Actually, the same place.
Huh?
Doesn't really, in the same place, but it doesn't really matter if it's cross-secured, does it?
No, it's not, it's unsecured debt.
Oh, it's good.
I didn't say that.
Top
But
co then.
So go to the hotel operation.
Where would they put it,
cash
though?
flow.
Same company.
well, okay, where though? I mean, hotel operations are property.
Oh, no, yeah.
Well, I mean, these, you have two companies afterwards, one of which does hotel operations, the other does property.
So the top co is not there anymore.
No, the top, the old company, Marriott Limited, is one of these. It doesn't make any difference
is it?
which one.
Property then.
You put it in the property.
It's
Okay.
secure.
Why would you do that?
Set the security.
Huh?
Set the security over the property.
But hang on, it's unsecured.
Oh, in
go
which
to
case
the
hotel
hotel
operations.
Why would they put it in the hotel operations?
It creates the cash flows to repay the debt.
That's exactly it.
Yeah, but what are you trying to do here? But remember, you see, I mean, all of this is the same economic. It's the same economic structure, you know, because the hotel operations are going to rent. They're going to rent the property, aren't they, from the property company? So I mean, it's the same economic structure, except there's two sets of limited liability down here.
Put it in the property,
They put in the property. Why?
because they pass the debt on to the property and one
Well, why would you do? Oh, yeah, okay, but what's the?
the risk or the liability they pass on to the property.
Yeah, but hang on.
Is it the asset value?
Yeah, but what are we trying to do here? What did we do here?
We sold the,
Well, what did we ultimately do?
So
just
Refund.
bought the,
Yeah, but what was the, like in a very simple 3 or 4 words, what did we do?
we paid the old debt from a new debt, which is worth cheaper than the.
We screwed the old debt holders. I
Yeah.
guess maybe that's what you're trying to say, but you're not capable of saying it in 3 words. Yeah, yeah. No, that's yeah. We screwed the old debt holders, and we gained. So it wasn't just a bit of sadistic behaviour.
Yeah.
You know, we enjoyed screwing the old debt holders. No, we benefited economically. Okay. So what are you going to do here if you're thinking of doing the same thing? Where is the debt going to end up here? Where? But if it goes in here, are the debt holders going to be happy? Or sad? Happy? Well, you're not in the business of making them happy, are you? Huh?
But the asset value has nothing to do with it. The equity.
Well, it's not magic now. I mean, you know, you say you put it in here because it makes the bondholders happy, but in fact, you know, what you're looking to do is to make them unhappy because that's how you managed to capture value here. So there's only one option left, isn't there? It goes into hotel operations. Okay, so there's still the same amount of cash flow floating around, but there's less for the debt holders. Now, if the debt goes in here, there's no security. Sure, there's no hard asset security. I mean, that's why, you know, in a sense, that's why a lot of people would say, oh, we put it in with the property because, you know, that's what the lender would like. But we're not in the business of making the lender happy. We're actually in the opposite business of making them unhappy. In other words, we want the debt to go down in value because we've injected a bit of risk into the debt, additional risk into the debt. The cash flows are still the same, but if anything goes wrong with Marriott, they don't have the cash flows, if anything goes wrong with Marriott, it means the cash flows go down. There's now less cash flows to repay the debt. If it was still up here, they could take the property, even though, there'd be property there to help to protect them. But if it's in down here with the hotel operations, there's nothing,
Yeah.
just pots and pans and mattresses and beds and bits and pieces.
So that's like a similar case of BHS then?
Huh?
Similar to BHS?
Well, did they, yeah,
Rather than
roughly the same, yeah.
this operation.
Yeah, so, I mean, this is then a real world example. This is your stylistic example. This is your real world example of what can happen, of what happens every so often.
The value of the loan, the debt will go down.
Go down, then you, like you say, you've got the picture now. You go back into the market and you buy it back, and that's,
Pay the old debt.
you repay the old debt, which is in the market trading at a lower price, and then you've captured the difference between the face value and what you pay. And that's permanent, a permanent increase in value. Okay. Okay, so, I mean, yeah,
I want to get your opinion on a situation where you have like a bank, it's publicly listed as a PLC. Then regulation comes out and say the bank has been into other non-banking activities, say insurance and other capital market activities. Then now regulation says now ring-fence the banking activity if you must hold on to this, float a holding company.
yeah.
And then the shares of the bank is now transferred to the holding company.
Yeah.
Does this also mean the shareholders of the old bank have been screwed since their shares are not transferred to the holding company? Because the bank has now been separated. It's now a limited liability
Yeah.
company. While the shares that the shareholders originally held was for the bank when it was
On its own, yeah.
PLC. Now it's been transferred to a holdco arrangement, and the bank is separated from.
Yeah, but I presume the holding company, the shareholders in the holding company are the same as the shareholders in the original bank.
Yes. Yes.
Yeah.
It's,
Yeah. So, I mean, this you're describing the opposite.
yes. It's
You're
like
describing the opposite. Here we're describing moving around debt and
Yes.
property and hotel operations. What you're describing is moving around the shareholding to different parts of the structure. But it'd still be the same shareholders. Still be the same shareholders. Now, there is a related point which is kind of current at the moment. You know the view in the banking regulatory world that what needs to be protected is the core of the retail bank. In other words, that is retail depositors need to be protected. Like so, Barclays Main Street, so to speak, need to be protected, and the creditors of Barclays Capital Markets and Barclays Trading and all this kind of stuff don't need to be protected. You're familiar with that kind of idea. And so, one idea being promoted, and it's actually happening sometimes, is that there's a holding company, and in a holding company, and in one of the subsidiaries you've got Barclays Retail, and the regulator says basically, look, we're going to we'll look after the creditors here, the depositors. Over in Barclays, everything else, they're saying you're on your own. So, I mean, it's a version of what you're saying. In other words, they're creating a corporate structure where depositors get protected and where other creditors get unprotected or left unprotected, whereas they might have had more protection if they were all part of the one, because it's sometimes hard to separate out retail depositors from non-retail depositors. So that's what the authorities are trying to do, or in some cases in some countries. But it's the same kind of idea.
What stops the holding company from shutting down any part of the subsidiaries?
Well, there's nothing to stop them. But I mean, once they do that, they've got to repay. But you see, the holding company now strictly has no liability. I mean, remember, strict law, the limited liability resides in the particular corporate structure. And that's the point. And that's the point here. You know, the hotel operations, if it doesn't repay the debt, okay, all the hotel operation assets are going to go, but they're not going to be valuable because, you know, they're only pots and pans and mattresses and stuff like this. The property will be left, and still may be available to the shareholders. Okay. So now, anyway, that's what can happen. Now that's what can happen. But of course, it doesn't look very. I mean, it's borderline dishonest, isn't it? It's borderline dishonest. Maybe completely dishonest. But you know, it's certainly borderline dishonest. But of course, remember, a lender who lends unsecured, you know, is asking for this to happen sometimes. Isn't that right?
Yes.
Is asking for this to happen sometimes. Yeah. So they'll ask for more. Now, of course, depending on the stage of the banking cycle, you know, when it's really competitive in the banking cycle, they won't ask for more. And then when this happens, as it does every cycle, you know, then the unsecured people will ask for more, either a higher rate of interest or they'll ask for security. So that's now we're getting to the point. In other words, this is it happens. But it's certainly borderline dishonest. But whether it is or not, lenders know that this can happen. So I mean, they know there's it's kind of an agency problem. They know that, you know, they're going to get screwed. You see, in a lending situation, the bank is the boss, and the borrower is the agent. The borrower is the subordinate. So we know that subordinates try to screw the boss. So the banks know, they know it's an agency relationship. They know that every so often there's the risk that, you know, they're going to get screwed. So it's a lack of trust, an agency problem. It always has a cost, always has a cost. So, you know, as you suggest, that, you know, this is not free. Doing this is not free. In other words, the bank will try to impose beforehand, or the lender, I should say, the lender will try to impose a cost beforehand to protect themselves. And that's a cost, of course, because you're paying more. You're paying more. So that's the, so we can see that there is a possible contradiction to Modigliani and Miller. They say, you know, shareholders cannot gain from a shift in the capital structure, but we can see how sometimes the shareholder may gain. Isn't that right? Sometimes the shareholder may gain from a shift in the capital structure. In other words, by bringing in more debt or doing something like that, which is not exactly the same, doing something like that. So, but of course, it's got to be slightly unusual. You know, it's got to be, the only people that can do this are people who can borrow unsecured. Isn't that right? And who, well, obviously have limited liability, but you can only do this if you've got limited liability and you can borrow unsecured. Okay. So there's a contradiction to M&M here. Maybe it's not a big contradiction. But does everybody understand the kind of issue here? Because, you know, we're starting to understand why banks, lenders look for security, even though maybe it's not necessary, because this is the risk they run. Remember, everybody can borrow. You see, you can borrow, I can borrow unsecured, can't we? I mean, our credit card borrowing is unsecured.
Yeah.
Our credit card borrowing is unsecured. Now, I can't do this because I haven't got limited liability. I can't do this because I haven't got limited liability. But if I had limited liability, I could do it, couldn't I? I could borrow money on my credit card and use that money to buy an asset, which I then gave to another bank as security. And that would have meant the credit card borrowing that I had taken was lost to the lender. Now, I can't personally do that because I say, I don't have limited liability, but a company has limited liability can do it. Okay, so that's the limited liability is the important bit. And again, if it's in your head that you're borrowing from a bank, it doesn't work as well. Okay. Now, so that's the kind of, I've set it up like that for a particular reason, because I wanted to bring out the agency issues. In other words, the lack of trust that can be there, because this is one of the things that can happen. This is one of the things that can happen to a lender. Now, just going back to mainstream M&M, they basically say it doesn't matter what the risk preferences are of investors. The only condition, now this is just a bit technical and I won't dwell on it, but just to summarize what they say. Listen, they say it doesn't matter whether shareholders have a particular, or sorry, lenders or anybody have a particular risk preference. They're basically saying that, okay, let me put it like this. That let's say a company, you've got two companies, let's say you've got two companies which are exactly the same, except that one company is completely debt-free and the other company has some debt in the capital structure. M&M say the value of both of those companies has always got to be the same. It's always got to be the same. Okay, now, and they say, okay, you don't have to believe what I'm saying. You don't have to believe what I'm saying, but it's got to be the same, because if it's not going to be the same, let's say the levered company, the company with debt in its capital structure, let's say the company with debt in its capital structure is more valuable. Let's just imagine that the company with debt in its capital structure is more valuable. Than the other company. Okay, so what's going to happen? That means the other company is obviously less valuable. So what are investors going to do? Now I don't go into this in detail in the notes here, because it's just a step a little bit too far. But anyway, just to show you, give you an example of what might happen. The borrowers, people observe this, that the levered company, the borrowed company, is more valuable than the unborrowed company. Okay, let's say the borrowed company is 50-50, 50 debt, 50 equity. So people then, what they do is they borrow money and they buy shares in the unlevered company. They buy shares in the unlevered company. So that between their borrowing and the shares in the unlevered company, they now have a debt equity ratio, or a D over V ratio of 50-50. So now they've created for themselves a corporate structure or an ownership structure which is 50% debt, 50% equity. So now those two companies they were the same in every other way except for the amount of debt. Now they're exactly the same, aren't they? Now they're exactly the same. One company has debt. The only difference being one company has debt inside the capital structure, the other company has debt outside the capital structure. And they've both got to have the same value, because if the unlevered company was lower in value, had less value, well, people would start to buy it, to buy the shares to create this structure which was going to be the same as the other one, and it would drive up the price, so the value of the two companies were the same. So that's how they prove this works in practice. And the only condition, of course, is that when you borrow the money to create the new capital structure, that you've got limited liability. But of course, that's not out of the question either, because the people who would be doing this would be able to operate within a limited liability structure anyway. So there's a fair amount in the textbook on, there's quite a bit in the textbook. I don't think you need bother with it really. I think you just need to understand the concept of what I've just described. What I've just described is the only condition that investors can borrow or lend on their own account to create a replica company, to create for themselves a levered company which is the same amount of debt as this other company has. And they both of those situations have essentially got to have the same value. Another way that they kind of talk about this is the value additivity principle. Do you remember the value additivity principle that we had at the very beginning of the module? Basically says that once you've got things expressed in present values, you can add them together. So in other words, if we've got year 0 money and year 3 money, you can't add those together. That's apples and oranges you're adding together. But if you bring your year 3 money back to year 0, you now have present values which can be added together. So that's the additivity principle, that you can add together cash flows that are expressed in present values. Okay. So, and they take that idea and they basically say, we can slice a cash flow into as many parts as we like, but the value of the cash flows has got to be the same, no matter how you slice them. Whether you slice, whether you've got cash flows which are entirely equity, or whether you've got cash flows which are part debt, part equity, the value of those cash flows has got to be the same. Again, just I'm kind of repeating myself a bit now, that the value of a company is determined by its real assets. So, I mean, should a firm issue debt or equity or whatever, M&M say no, it doesn't make any difference. Now, and it is again a big if it doesn't affect investment or operating policies. Now, they say that, but subsequent to that, people have started to say, well, we've just got to probe the investment policies a little bit, and we've got to probe operating policies. In other words, what are investment policies? Well, if you borrow too much, does that encourage you not to invest as much? In other words, if there is such a thing as borrowing too much, which M&M say there couldn't be, well, if firms start to cut back their investment, that affects value, doesn't it? Because if you're not investing in real assets that create value, you're throwing away value. So that would put a question mark over what M&M said. Or also, there are agency issues, aren't there? If you've a lot of debt in your capital structure, you increase the risk that something like the Marriott example is going to happen to you, or in the other example that I had, that I gave, the simple example that I have. So, there are agency issues that M&M didn't really realize about, I think, that this agency stuff, it's really started to be understood much, much better only in the last 30 years, I suppose. I mean, when I was a student, we kind of knew about the problem, but we've started to realize that its significance is much greater now than we did a few years ago, 30 years ago maybe. So M&M didn't really, I think, have a full grasp, I suppose, of the agency issue. And that's the last thing we're going to probe then, I suppose, these operating issues. Before I do that, just summarize again. So the assumptions behind the irrelevance argument: the capital structure does not matter. If the firm can't create or offer a new financial service that meets the needs of some clientele, particular clientele. In other words, you're not going to create value unless you're going to be able to sell a security for more than it's worth. Now, I'll give you an example, though, of how this could happen. Another one, which would be something like this. Convertible debt. You know what convertible debt is, don't you? In other words, it's debt that you can convert into equity. What is that? It's actually debt with an option attached to it, isn't it? Debt with an option attached to it. That's the way we would think of it nowadays. But of course, options are valuable. So if you take a regular piece of debt and you add an option to it, it makes the regular piece of debt more valuable. So obviously, you can sell that piece of debt, for more than you could sell the debt on its own. Okay, that's fine. So, but of course, can you sell it for more than it's worth? That's different. Can you sell a convertible piece of debt for more than the value of the option and the debt? But I imagine, now this would have happened a long time ago, but I imagine the first person to create a convertible piece of debt was able to sell it for more than it was worth. In other words, it was a new invention. Whenever it was invented, maybe 100 years ago, it was a new invention. Whoever invented it was able to sell it for a bit of a premium. But of course, nobody has a patent on that. So I guess the next person did it in the third and fourth. So after 10 goes, the thing started to trade at its real value. Okay, but we're not ruling out the possibility that maybe somebody invents a new financial security that they're able to sell for a little bit more than it's worth. Okay, so that's what that point is about there. So it's an if. It's not an if that we can rule out. Or another Now, but this is the other point. Assumption by the irrelevant capital structure does not matter if it does not affect the cash flow stream. That's the point I developed there a second ago. In other words, if there's no taxes, well, of course, if there are taxes, debt becomes more valuable, doesn't it? There's no bankruptcy costs. That's actually a part of perfect capital markets as well. No bankruptcy costs. But bankruptcy costs are real. You see, sorry, I shouldn't say M&M, but a perfect capital market, it basically says there's no bankruptcy costs. In other words, assets are sold for exactly what they're worth. You don't lose anything by selling an asset in a bankruptcy as opposed to selling the same asset in a non-bankruptcy. But that's not true either, Oh, well, hang on, it's not never true. I mean, if a property owner goes bust, they can sell the property at almost the same as they could sell it if they weren't bust.
For sale value,
What?
For sale value, you are going to get less.
No, you may not necessarily get.
You may not necessarily get less.
So that's why you said never true. That's not true. Sometimes it's true. Now, that's one of the things we're going to have to look at in a minute or two. When is it true? When is it not true? If good old Nigeria Airways goes bust, well, the planes are still worth whatever they were worth. Somebody comes along, takes a pot of paint, puts a new logo on the tail, off they go. They've maintained their value, a bit like a property. And they're even better than property because they're mobile. Okay, a bit of property in London. If the property market in London is screwed, well, you can only sell your property in London. But if you've got an airplane that's owned by British Airways, it can be sold wherever airplanes are used, and so they work. But anyway, so we're going to look at the particular assets that hold their value and the particular assets that don't hold their value in bankruptcy. But M&M say, look, there's no loss ever, which is, well, they didn't say that. The perfect capital market assumption says there's no bankruptcy cost. So we've got to add that into our picture as well. We've got to add that into our picture as well. And the third point is there's no effect on management incentives. Okay, now remember dividends as discipline. Remember dividends as discipline. I mean, that said, hey, if companies are paying a dividend, it puts a bit of pressure on management. Well, we think the same thing might apply to debt. In other words, if companies have a bit of debt, maybe a little bit more debt than is normal, that puts a bit of pressure on management. So a little bit of debt, more than maybe normal, okay, makes the company riskier, but maybe also it keeps the management straighter, keeps them under a little bit more pressure, less likely to do stupid things. Okay, so that's the agency, part of the agency issue there, okay, so we've talked about this one. Now we're going to talk about when the irrelevance argument does not hold water, where there's taxes, where there's bankruptcy, and the management incentives as well. Now, just to wrap it up, basically M&M say there's no magic in financial leverage. No magic in financial leverage. If the capital markets are working well, you can't increase firm value by playing around with capital structure. Now, we've seen exceptions to that, the Marriott type thing. But a stupid example is this, but it might help you to remember. It shouldn't cost more to assemble a chicken than to buy a whole one. Did you ever try to assemble a chicken?
The one that has been dismembered?
Yeah.
It's there in my stomach.
No, I mean,
Go to KFC and order different
Buy the different.
different parts should be the same as
Yeah.
the-
So in other words, if you buy 2 legs, breast of chicken, etc., whatever is in a chicken, and you put them together, well, you buy them, it should cost you the same as to buy a whole chicken. That's what M&M say.
and then I do what-
That's what M&M say, but it's not true. It's not true. It's not true. Okay, but why is it not true? Well, there's transaction costs in chopping up the chicken, and there's transaction costs for you in putting it together. So, I mean, it's not a stupid example. It was getting us to remember the perfect capital market exceptions, transaction costs. And there's another point, which is irrelevant, not relevant in the capital markets, they're taste. There's taste issues. I mean, have you ever tried to get your kids to eat the brown stuff? The legs of the chicken? Well, when I was a kid, I used to like the brown stuff, but now modern kids, but anyway, so there's taste. So the breast of the chicken is more valuable than the equivalent amount of protein or whatever it is in the leg. So there's taste, but there's no taste in the capital markets. So it's that example reminds us no taste in the capital markets, but there are transaction costs. But funny enough, in the article where they developed this whole theory, they finished up by saying, you know, it shouldn't cost more to assemble milk than to buy whole milk. In other words, it shouldn't cost you more if you buy cream and skim milk and mix it together in the right proportions. That should be the same as the price of ordinary milk. And of course, the funny thing was that, I mean, they could investigate that point immediately just by going down to the shop. The next person who replied to their article did that and said, look, it's not true. You can't create milk at the same price by buying cream and skim. But anyway, that was the article that was the example that they gave in their own article, which shows that, you know, these guys, I suppose, kind of make mistakes, same as everybody else. Now, but let's deal with we want to deal with these issues at the bottom of the page, because these are more real world issues at the bottom of the page. Okay, so we talked about that. So M&M depends on perfect capital markets, but okay, capital markets are not perfect, and when we relax the assumption, the effects go different ways. Remember, when we relax the tax assumption, it means debt is more valuable. When we relax the transaction assumption, it goes the other direction. When we throw in then also agency problems, you know, the thing gets messier. So the capital markets, the big ones anyway, work reasonably well, but they're not by any means perfect. So our job is to understand, you know, when M&M are not correct. That's our job. So we're left with the question of how much should a firm borrow? That's the big question we're left with. How much should a firm borrow? Okay. Now, I mean, this point here is fairly simple. The factors which may affect the target debt-equity ratio. Well, there's two factors. One is taxes. Well, sorry, we look at this trade-off for a start. We look at this trade-off here. We look at this trade-off here for a start. Now, we've got two firms here. We've got the levered firm and the unlevered firm. Okay, here's the unlevered firm. They're identical except for the capital structure. This is the unlevered firm. It's got equity of 1,000. It's got sales 200, expenses 50, profit 150. So its ROE, if you just think of it even as an accounting ROE, its ROE is 150 over 1,000. Well, any kind of an ROE. So it's 15% anyway. So the return on equity is 15%. Now, in the unlevered firm, in the levered firm, what we have is we've got equity and debt. It's 50-50 debt, equity. Got sales, exactly the same, 20, expenses 50. We've got interest, which remember is a distribution. It's like a dividend. It's a distribution. It's not an expense. Although now this is where your accounting numbers lead you astray. Our accounting systems treat interest as an expense. Isn't that right?
Yeah.
But that's not correct. It's just the way. It's just the way the tax system is set up and the way everything is set up. But it can lead us astray that we think of interest as an expense rather than as a distribution. But anyway, interest, let's say, is 50, 10% on the 500, giving us a net profit of 100. Okay, so your net profit is less, and you can in the net profit here, it's basically the same as cash flow. So we're not we're not making a big no-no, not making a big mistake by using the word profit here. So our ROE then, our return on equity, is 20, isn't it? Mm-hmm. Okay, a return on equity. So that's the benefit of debt, isn't it? That's the benefit of debt. Okay, you can see it straight up there. That's the benefit of debt. We've got a higher return on equity. Of course, what's the reason for that? Well, some of the financing comes in at a lower return, doesn't it? The debt comes in at a 10% cost, whereas the equity is coming in at 15%. So of course, if you replace part of 15 with 10, you're going to get a bit of a surplus. So that's where the extra return in equity comes from, the fact you've replaced expensive equity with cheap debt. Okay. That's all there's to it. So it's very simple. It's very simple where the benefit of equity, of leverage comes from. It comes from debt being cheap and equity being expensive. Simple as that. Now some people say, oh no, debt is expensive and equity is cheap. A huge no-no. A huge no-no. Equity, by definition, equity has got to be more expensive because it's more risky. However, what's the difference between debt and equity, between the return on equity and the return on debt? Debt's a fixed return. You've got to pay it every year or whenever. Whereas equity, you don't have to give the return every year. You don't go out of business if you don't give the return on equity in a particular year. If you don't give the return on debt in a particular year, you go out of business. Okay, so that's the difference. You know, it's not that one, but at the end of the day, debt is cheap and equity is expensive. One is flexible, which is equity, and the other, which is debt, is inflexible. Okay, and actually, flexibility is always expensive, isn't it? I mean, another word for flexibility is an option, isn't it? Options are always valuable, and that means they're normally expensive. Okay, right. So that's the benefit of debt. We want to deal with these other three issues now. So this is why we like debt. This is why we like debt. Let's see what happens when we throw debt into the capital structure. Okay, now debt and taxes. I mean, I've been a little simplistic in describing it up to now. I basically said that, you know, debt is subsidized by the taxpayer, as it is in most countries which have corporation tax. So in the jargon, debt provides a corporate tax shield. In other words, it's a subsidy from the taxpayer. Now, however, that's the simple view of the world. A more subtle view of the world is along these lines. Remember, you get the subsidy from the taxpayer if you're paying corporation tax, isn't that right? You pay corporation tax when you're making profits. The more debt you have, the less likely it is that you're going to make profits. Because, you know, the more debt you have, the higher the interest expense, and at some point, your interest expense gets so large that you're not making a profit. No more subsidy from the taxpayer. Okay, so that's the first subtlety. That's the first subtlety. The more you borrow, the less sure you are of being able to use the tax shield.
So is that the case of what is going through with Apple and Ireland currently?
Not really, no. No, that's nothing really got to do with, no, that problem is nothing got to do with debt or anything else. It's just got to do with whether no, it's got to do with, well, the European Commission says it's got to do with the fact that Apple got a special deal. That's the argument. Whether Apple got a special deal from the revenue or whether they didn't. So that's the argument. So it's nothing got to do with debt or equity or anything. It's just about, it's what they call that subsidies to individual companies. Okay. Now the second point is that equity investors also get tax breaks. They also get tax breaks. Sometimes pension funds are not taxed until they pay out. In other words, that dividends are in some countries compound without tax. You know, they're called gross funds. Sometimes they compound without tax. Secondly, capital gains. Remember, one of the ways a shareholder gets a benefit is by way of a capital gains tax. Is by way of an increase in the share price, which is taxed by way of capital gains. Which, 2 points. One, capital gains tax is usually at a lower rate than regular personal tax or regular any other kind of tax, first point. And secondly, capital gains tax is paid when you realize it. So it's deferred, isn't it? So your wealth is going up, but it's not taxed until you cash in your shares. And of course, wealth tax deferred is tax reduced. The present value of tax is reduced if it's deferred. Okay, so that's a tax break. That's a tax break. So the basic conclusion is that, okay, you know, for profitable firms there definitely is a benefit. For profitable firms there definitely is a benefit, but this benefit is not as big maybe as you might think, but it's definitely there. Okay, that's the first point. Messy, it's slightly messy. Now, not terribly messy, but slightly messy. Now, in the real world, what else do we have to wonder? What else do we have to? We have to. I suppose just introducing a reality check here. In the real world, we observe that in a given industry, firms have a particular debt ratio. You know, in a given industry, you'll find normally that firms have a similar debt ratio. And that's different across industries. So some industries have highish debt levels, other industries have lowish debt levels. Why is that? So, I mean, M&M say, gee, this doesn't matter. And remember, of course, taxes affect these companies, I presume, the same way. So that doesn't explain why they've got different debt levels. So we've got a little bit of explaining to do. For instance, airlines, utilities and banks, they rely heavily on debt. So you might say, well, maybe it's got to do with the riskiness, but not really. But, okay, airlines are risky, but they have a lot of debt. Utilities, electric companies and so on, they have a lot of debt, but they're not risky. Banks have a lot of debt, colossal amount of debt. I suppose they're medium risk. So low risk, medium risk, high risk. They carry lots of debt. So it's clearly not just the riskiness of the company, whereas drug companies don't use much debt, even though they're quite low risk. They're modestly low risk. So, I mean, we've got a bit of thinking. We've got a bit of thinking to do. We've got a bit of thinking to do. So let's do the thinking. What have we left out? Well, we've left out, as I say, taxes. We haven't talked about distress, you know, bankruptcy, and we haven't really talked about the conflicts of interest between security holders, like in the Marriott case. That's a conflict of interest between shareholders and debt holders. So let's probe that. Let's probe that a little bit. Let's probe that a little bit further. And we've also, you know, we've ignored the fact, we've ignored the information issues. Debt is easier to value than equity. You need less information to value debt. If you're the outside of a company, you need less information to value debt. So that means debt is going to be easier to value because you've got more information, or you don't need as much information to value debt. And we've ignored also this agency problem as well that we've talked about. So we have got to kind of think about that. Okay, so we're going to pull together, we're going to try to pull together taxes and the cost of bankruptcy and management incentives. So before I do that, let me give you, let me show you what the answer, well, not the answer, but part of the answer, what part of the answer looks like. What part of the answer looks like. Okay, it's got a little graph here. Down here we've got value, the value of the company, and here we've got D over V. Okay, so here we've got the proportion of debt in the company, and here we've got the value of the company. And the graph looks a bit like this. The graph looks a bit like that. In other words, what it's looking like when there's a low, as you add debt into the capital structure, okay? As you add debt into the capital structure, the value of the company goes up. Not as sharply as that, but anyway, the value of the company goes up as you add debt into the capital structure. Why? Tax. As you add debt into the capital structure, you get a bigger and bigger subsidy from the shareholder or from the taxpayer. And that's valuable, you know, that's valuable. Until you come to a certain point, where you've added too much, you're adding too much debt into the capital structure, and then you're significantly increasing the chances of going bust. In other words, you're increasing the chance of bankruptcy, of losing money in a bankruptcy. So over here, let's use the word distress. Okay, so it's a trade-off. It's another of our famous trade-offs. Up to a certain proportion of debt, the tax effect is strongly felt. And after a certain point, the distress effect is strongly felt. Now, unfortunately, we can't determine, we can observe where this point is, but we can't determine where it should be, or we can't determine how it got there. We can just observe, that in certain types of companies, the point is here. Or for other types of companies, the point is somewhere else. Okay. But I think we can certainly figure that there's a trade-off. We can certainly figure there's a trade-off. We're trading off the benefits of tax against the cost of distress caused by being bounced out of business by going bust. Okay, so that leads M&M to come up with this idea. They say the value of a firm is equal to the value of an all-equity firm. In other words, a firm with no debt, plus the value of the tax shield. Because remember, you can work out the value of the tax shield. There's no complication there at all. If you're borrowing so much, you're paying so much interest, you can work out the tax saving on that interest. So that's got a very easily ascertainable value. So it's the value of an all-equity firm, which you value in the normal way using CAPM, plus the value of the tax shield. Okay, that's hard to argue with that, except that would say that you should have 99% debt. Isn't that right? Because the more debt you have, the bigger the subsidy from the taxpayer. But that's not the way it kind of can work, I suppose. What are we missing? Well, we're missing, excessive debt. We're missing excessive debt where there's going to be a cost of distress. Okay, so M&M say, well, fine. What about this? The value of a firm is the value of an all-equity firm plus the value of the tax shield, which we've had already, and then they're saying less the present value of the cost of distress. They're saying less the cost of distress. Of course, the cost of distress is much harder to figure out. You can work out the present value of the tax shield exactly, but it's an awful big problem to work out the value of the cost of distress. But in any case, that's the model, I suppose. That's the model, and what's missing, of course, really is the agency issues. We're missing the agency issues from that as well. So a more modern interpretation would be something like the value of a firm is the value of an all-equity firm plus the value of the tax shield minus the cost of distress minus agency costs. But they're even harder to figure out. So, what are the, okay, so let's focus now on the cost of distress. There's 4 costs of distress. There's the bankruptcy cost. What's that? Well, that's the cost, 2 kinds of costs really. One is the cost that you're not able to sell the assets for their normal economic value just because the company is bankrupt. In other words, that some assets lose value because they're being sold by a bankrupt company. But that, we learn that varies from asset to asset. As we mentioned, an airplane holds its value in bankruptcy. And the second cost of bankruptcy is just, you're paying money to lawyers and accountants, all of these characters, to put the company to bed. Okay, so there are 2 kinds of bankruptcy costs. But the first one I mentioned is the bigger cost. And secondly, even before a company goes actually bankrupt, if it's on the borderline of bankruptcy, that's expensive as well. Because we were talking at lunch, like, say Nigeria a bit short of foreign exchange, so everything is more expensive to do. In other words, if you want to go on a foreign trip, if you have to go on a foreign trip, you know, you've got to run around a hell of a lot of transaction costs getting the foreign exchange. So, I mean, that would be the kind of, not just the price of the foreign exchange, but the transaction costs of getting it. So, I mean, when you're operating in distress, you know, what happens is, you know, you lose key employees, because they say, well, we want to get out before the company goes bust. You're paying the guys that remain more. You're losing discounts for not paying on time. People are refusing to supply you unless you pay cash up front. All of these things are expensive. So there are costs before you go bankrupt. You may never go bankrupt, but you run these costs because bankruptcy is a possibility. And then there's the conflict of interest between bondholder and shareholder. That's what we saw before in that little example, and in the Marriott case. That's what we're talking about here. We'll develop that in a second or two as well. And then, of course, when a company is bankrupt, you know, I suppose it's a version of the cost of operating in distress, but lenders start writing tighter and tighter contracts. You know, they start to impose security. They start to monitor. They look for information all the time. You know, they're generally making your life a misery, just like you guys do with banks. You know, banks do with you know, with borrowers. Okay. So that's the little graph there. That's what I'm describing here in words. Okay, that's fine. We've done that. So let's take an example. Let's take some examples of the conflict of interest. That third point there, the conflicts of interest between bondholders and shareholders, which we started to probe in this Marriott case. Okay, so Transylvania Electric has $50 of 1 year debt. Okay, so that means it's got borrowed $50, which matures in 1 year. They've got to repay it in 1 year. Okay, that's what that means. Now, this is the little balance sheet. I call it the book value of the balance sheet. It's the book value of the company. I suppose you could say it's what the company looked like before it starts to get into trouble. Okay, so it's got net working capital of 10, it's got fixed assets of 90, the debt and the equity are both worth 50. Okay. But, however, now they're in a bit of difficulty. The net working capital is still worth 10, but the assets have fallen in value. The assets have fallen in value for whatever reason. In other words, maybe the assets have fallen in value because they're not capable of producing the cash flows anymore for whatever reason. So the company is worth, the financial asset, the securities are going to be worth, what is it there? 40, isn't that right? The assets are worth 40, the financial securities are worth 40. Okay, now we've got a bit of a conundrum. But the question, I suppose, is this: why does the equity have any value? Remember, the bank is owed 50, isn't it 50? The bank is owed 50. Why has the equity got any positive value? I don't mean 10, but why is it not 0? Okay, so that's the question you can have a little think about. Okay, now don't ever you speak together. Why has it got any value, the equity?
The shares are still holding some value.
Well, why though? I mean, on the face of it, they're worth nothing. The assets are worth 40. The debt is due to be repaid 50. That means the equity is in the hole to the tune of minus 10. Limited liability, it's worth 0. So why is it trading on the market with a positive value? I just picked 10 out of the air.
Because we still have fixed assets.
Yeah, but tell me more. When the fixed assets are worth 40, debt 50.
Still the value of the company, if you went bankrupt, you're still going to get 10 at least.
Why? But I mean, hang on. The company goes bust now, shareholders get nothing. Because the bank is owned, the lender is owned 50. Owned 50.
But you still have the working capital now.
Yeah?
The working capital of 10 is still there.
Yeah. So, yeah, okay, but where does that take us? How does that... I mean, if the company went bust now, The lenders get the working capital and the other assets. They get 40. They're still 10 short, but the shareholders gets absolutely nothing.
The equity will be preference shareholders.
No. Keep it simple. No. I mean, that's not, we haven't mentioned preference shareholders, but. Why has it got any value? I mean, for really important question. Transylvania Electric has $50 of 1 year debt. In other words, this debt is due to be repaid in a year. And it's got a face value of 50. In other words, that's what you're due to repay in a year. Why has the equity got any value? Okay, well, I think that's the answer, really. I mean, okay, I'll ask the question a slightly different way. This equity is a cross-dresser, basically. It's not, it's got the legal form of equity, but in fact, it's behaving, it is actually another form of financial instrument. What form of financial instrument is it, in fact, as opposed to in legality? Huh?
And therefore?
Well, okay, so there's only a limited number of financial instruments you know about, not preference shares, not equity, because it is equity, or it has a legal form of equity. It's not a bond, because it's not a bond, definitely not a bond. So what other financial securities are you familiar with?
Option.
Yeah, option. Did you say that, Mark? Oh, yeah, okay. Yeah, it's an option. Is that a pure guess, or do you want to expand on it? Okay, nothing wrong with that. Okay, he's right. No, yeah, it's an option. This equity is dressed up, sorry, this option is dressed up as equity. It's got the legal form of equity, but in fact it's an option. It's actually behaving as an option. It's valued on the market as an option. As an equity, remember, it has no value. The reason it has a value here, not necessarily 10, but the reason it has a positive value is because it's an option. And what is the option? Well, the option is, along these lines, the option is, like, we've got a year to go. It's a 1 year option, isn't it? It's a 1 year option. During this 1 year, something may happen. In other words, we can pull off a stunt. The economy may improve, whatever it is. But if the assets of the company are worth 60 in a year, for instance, if they're worth 60 in a year's time, the shareholder collects 10. They pays the bank 50, collects 10, the shareholder, now back to be the shareholder. The option cashes in with a value of 10. So in other words, people, figure that, I mean, if this was debt, was 5-day debt, the equity would have no value. But this is a 1 year option, basically. I think something may happen during the year. So that's why it's got a value. So you often see that, actually. You often see that equity in really bankrupt companies. It's rarely got a zero value. And the reason for that is because something, just may come out of the woodwork. The liquidator, which sometimes happens, the liquidator may find a legal claim against somebody. It happened with an airline years ago, Fred Laker. It went bust. But the liquidator basically said, hey, British Airways put it out of business by using market power, which they shouldn't have done. You owe us money. So that was enough to cover the cost of the liquidation and the deficit and give over something to the shareholders. The liquidator just managed to create a claim. Just so, these things can happen. Okay, so that's why it's got a value. So that kind of sets the scene. That kind of sets the scene for the things that may turn out. Now, the things we're going to look at, the good news is we won't look at them immediately. Things we're going to look at is, what might happen? What might happen during the year? What might happen during the year? And this, this tells us about the agency problems, and it also tells us about why the equity is actually an option. Okay, but it's 3 o'clock now, so we'll take a break, will we? We'll come back at 3:30. So again, as is the case, which is not universally recognized, 3:30 means 3:30. So we see you at 3:30.